Okay, so let's get going. Good morning, everyone. To those I haven't said good morning to, welcome to our Pulse update for July. Let's get the session going. So first up is going to be Imtiaz Suliman. He is the head of our Shariah portfolios, heads up the Shariah Solutions set, and he's basically Sentio's face of Shariah. He is a chartered financial analyst and a portfolio manager with Sentio. He's got many years of experience and very well versed in anything Sharia. So if you have a question related to that, please ask him. But without any further ado, Imtiaz, over to you.
Thank you, Verlyn, and good morning, ladies and gentlemen. Thanks for joining us today. I'm going to touch a bit on some of the themes that we're looking at. And as Verlyn mentioned, one or two stock picks that we hold in the portfolio, and we'll have a discussion around that. But please feel free to either type in your question in the chat box, send Verlyn an email, or ask any questions at the end. It's been a very volatile macro environment, and we've been in quite a volatile environment for some time. Post the GFC, the Great Financial Crisis in 2008, central banks have really stepped up their monetary policy response to try and deal with the massive changes that we've seen in the economy. And we've come through a period of very low interest rates. And now we're in a period of essentially much higher interest rates. If you look at what's happened since COVID, you had a shutdown of the economy, and worldwide, supply chains were disrupted massively, which had a huge impact on inflation. And inflation is something whereby central banks are grappling with at the moment. We've seen a period of low inflation culminate in now a period of high inflation, although the trend of inflation is declining. So the Fed is very resolute on making sure that they get the inflation down to the 2% level. And although inflation has been coming down, it's not yet at the 2% inflation target. But nonetheless, the trend is still positive. And this is, due to the massive base effects that we've seen. You've had energy prices spike, food prices spike, shelter, housing, and that's had a major impact on inflation. Now, there's a very nuanced and a balancing act that the Fed needs to maintain. They've got a dual mandate. The one is to maintain full employment, but also maintain price stability. And that balancing act is something that the Fed needs to get right. It might be easier said than done, because once you do adjust monetary policy, the impacts are only seen 18 to 24 months down the line. So there's this massive lag in terms of monetary policy and the impact that it has on the economy. US employment has been quite strong, although we've seen some weakening since the lows that we've saw. From a growth perspective, the one exception is the US versus the rest of the world. We've seen China, had a strong opening post-COVID, but since then they've lagged quite meaningfully. And this has been, some structural issues that China is dealing with. The one is low consumer confidence. The other is housing, which is sort of going through its own mini bubble in China, where they had massive build of housing stocks. And this has an impact on inflation, but also on consumer confidence, because in China, a large part of their consumer savings is made up of housing and residential investments. From a geopolitical standpoint of view, we've had the war in Russia and Ukraine continue for almost 2 years now. We've seen other areas flare up in terms of conflict. And this is something that has an impact, one, on supply chains, because it affects the likes of maize, soybeans, oil, etc., but also in terms of the impact it has on global alliances and ultimately, what does that mean for global growth? I'm going to touch on Bidvest, which is a stock that we've held in the portfolio from time to time in varying weights, which has done particularly well for the portfolio. And Bidvest is really a diversified industrial company that spans across a number of different areas in South Africa. Increasingly, they're moving offshore, and what that does is it brings some stability in terms of their foreign income, but also gives them another lever for growth outside of South Africa. Usually, when companies do venture offshore, it's a bit of a hit and miss effect with some successes, but a lot of failures. But in the case of Bidvest, they have a very strong record of executing well and also playing in a very defensive space. So globally, they play in the space of services, which is very defensive in nature. You know, the hygiene services, it's all linked to the reopening of the economy, more people getting back to work and going to offices, and also tourism. As international tourism rebounds, Bidvest is well placed to benefit from that. It's a high quality company. They generate very good returns on their capital. You look at their returns on equity at around 20%. They've got a good management in place, and they generate good margins. So the cash flow generation is very good. They operate in a very decentralized basis, and although they have quite a few different segments under the Bidvest stable, that's very much all linked towards a GDP play, which Bidvest is very well placed to benefit from any uptick, both here in South Africa, but also in the UK, in Ireland, which is the other geographical jurisdictions that they have exposure to. So we've liked Bidvest. The valuation has been quite attractive. From a PE perspective, it's trading on a forward PE of 14 times. We've held it as a core part of the portfolio, given its growth and quality metrics. And we still think there's decent upside in Bidvest. So if you look at our target price, it's currently trading at around 285 Rand. We still see 18% upside in the counter. And as you can see, it had a very strong run in June. And we'll speak a bit about the South African market and its response to the recent political developments. One stock that has been a detractor over the last month has been Ulta Beauty. And this is a US listed company that has exposure mainly to the US in terms of the health and beauty segment. If you want to equate it to a South African equivalent, you could think of it as a combination of the beauty segment that Woolworths has, combine that with a Sorbet, which does beauty treatments. And this is the price graph that you see in front of you. And this vertical line is the point that we've entered the stock. So as you can see, we've tracked the stock for a number of years. We've held it in the past, we've sold out of it. And given the recent fall in the share price, we see an attractive opportunity to enter into the likes of Ulta Beauty, given its strong growth metrics. So Ulta Beauty is a growth counter that has very strong growth in terms of new space rollout. They still not penetrated in terms of their geographical presence that they operate in the US. They've got a very loyal customer base. If you look at their loyalty card and membership base, that's around 37 million consumers and growing each and every month. They stock a lot of different beauty products. They've got ranges across the board. They also have their own in-house private label range, which is becoming an increasingly important part of their offering. So Ulta Beauty is something that generates good returns, has high returns on equity, and increasingly we see that high returns translating into good cash flows, which ultimately allows them to buy back shares, pay a higher dividend, and provide a a total return to shareholders that's very attractive. We've seen the recent weakness come through, and that's again on the back of them guiding that revenue is not going to be as strong as it was in the past. We're not really concerned about that lowered guidance because there's a bit of a cyclical slowdown that the company is going through. They have been growing very strongly, and it's natural to see some sort of cyclical slowdown given the strong growth that the company has generated historically. So we think it's a very opportune time to re-enter Ulta Beauty, and we did take a position in Ulta Beauty in around the mid-April of this year. And I think the attractiveness of the returns and from a fundamental basis, we still see that you could get around 27% returns that we're expecting on just very conservative assumptions for the share. In terms of what we're looking at for the coming months, we're going to get to the second quarter earnings in the US, and this is going to be quite a nice indication of what is happening on the ground from a consumer perspective, but also from a company perspective. Companies have been generating very strong returns with margins that have been expanding. And we've seen some signs of that changing. The consumer has started to pull back on some of the discretionary spend, and companies have also started to allow their margins to decline because of the high input prices that we've seen. Last year was a different story, whereby a lot of those input prices could be passed on to the consumer, and companies enjoy the benefit of higher margins. From a Fed perspective, the Fed governor has been speaking over the last few days, and there's a lot of indications that it looks like the US has reached the peak of the interest rate cycle, and the next move is certainly going to be a cut in the US rates. We've seen some cuts around the world. Europe has started cutting interest rates. We've seen Canada cutting interest rates. And I think the Fed is going to be in a position whereby they can also start cutting interest rates. And why this is important is because when you do have high interest rates in the US, it really sucks up liquidity from a global perspective. Our own Reserve Bank, although inflation has been declining, they very hesitant to cut rates ahead of the Fed because that will put pressure on the currency, which would put pressure on inflation and really undo the interest rate cuts that they do, preempting the Fed. So although some central banks have moved ahead of the Fed, we think once the Fed start cutting interest rates, that would also put less pressure in terms of emerging market currencies, where we see some dollar weakness come through, which would allow emerging markets and markets outside of the US to fare better. In terms of job openings, I spoke about US unemployment. We've got another indicator, which is the jobs openings number. And, at the peak of that cycle, we've seen the number of job openings to the number of unemployed people in the US really being double. So you had double the number of job openings, but half the number of unemployed. That number has started to come down. And this is another indication that the labor market is not as tight as it has been in the past. And why that is important is because if you have a very tight labor market, wage inflation is something that the Fed is watching very closely because that really drives the overall inflation rate. And then global growth outside of the US has been patchy. We've seen Europe sort of get some reprieve from the higher energy prices that came after the Russia-Ukraine invasion. And we've seen energy prices start to moderate quite significantly since then. China, as I mentioned, has also been muted. And it looks like their central bank is very hesitant to just open the taps and stimulate the economy. And China is very important for the likes of South Africa because we export a lot of commodities to China. I just like to touch on one of the slides, speaking really to the opening that we've seen or the performance that we've seen post our election period that we've come through. If you look at June in terms of the MSCI South Africa, it was a very strong month. Our market was up 9.5% in US dollars because of the rand strengthening. If you take that in local currency, our market was up around 5.5%, but nonetheless, a very strong showing from South Africa. There's often a debate of how much assets we need to allocate to South Africa versus global, and it's something that we look at on a constant basis. But what this highlights is that when positioning is very underowned, and South African assets have been very underowned for a long period of time, valuations have been attractive. We've seen, some of the counters trade on our market at 4, 5, 6 PE multiples with dividend yields of 6, 7, 8%, and that's very attractive. And then you've got a favorable political outcome in terms of the election period. We came through it without a period of any violence. And also we've had now 105 days of no load shedding, which really bodes well for company earnings. So that's been a positive showing, and that's come through from the strong market performance that we've seen in June. From here on, the question could be, how sustainable is the rally? It's all going to be dependent on the earnings that come through. And companies really need to deliver on earnings. And if they do deliver on that earnings, we should see further outperformance from the market. Thank you. I'm going to leave it there and hand over to Verlyn for his section, and then we'll take questions.
Okay, thank you, Imti. I've got a question here quickly from my son. So he said, what are we looking at in terms of Shariah stocks and sukuks locally over the next 6 to 12 months, considering that local Shariah funds have been struggling versus conventional peer groups? I think that speaks a bit more about our process versus our peer group.
Yeah, thanks for the question, Nelson. I think, when we look at the performance of Shariah funds, as you've mentioned, there's been quite a bit of divergence between the overall performance of the different Shariah funds. But our fund in particular has done very well. And this speaks to, the strong stock picking from a bottom-up fundamental basis, but also some of the global growth counters that we've held in the portfolio that have done particularly well over the period. So if you look at both the balance fund as well as the Shariah equity fund, they fare very well against its Shariah peer group, but also against conventional funds out there. From a asset class and stock picking perspective, we've had exposure to the sukuks, the local sukuk that the government issued. That provides a very decent yield. We've also had some exposure to some of the global sukuks, which gives you yield in dollars, and that's also been quite attractive. We're going to see, I think, a lot more sukuks come to the market as corporates get more familiar with the concept of sukuks, and there are indications that that is going to ramp up in the near future. And then just lastly, touching on the stocks, we've seen the local stocks do particularly well, as you've seen in the chart from the MSCI South Africa, and the likes of Bidvest, which we've held in the portfolio, Clicks, Mr. Price. They've done all particularly well over the last few months.
Okay, that's a comprehensive answer. And just one more question, Imti. What's your view on offshore equities and sukuks as a ZAR-based investor over the next 1 to 2 years, given the rand's inherent dollar currency weakening over time? So the weakness of the rand.
Yeah, I think, we always tend to think of the rand as a one-way bet, and it does feel like that sometimes, whereby the rand does weaken, and it has weakened. But you also have periods of strong outperformance whereby the rand can do particularly well. And our philosophy is to have a strategic asset allocation whereby we allocate assets both locally as well as globally, and finding those assets globally that complement the local assets quite nicely. So if you look at it from a style perspective, South Africa is a value-heavy market whereby you don't get a lot of exposure to quality growth counters, and that's where the global counters come through. So we've got a lot of value exposure locally, but when we do invest globally, we tend to favor the quality growth counters, which allows us to benefit from those styles that are not available locally. The one other option that we do have in the portfolio from a rand perspective versus dollar perspective is that we have a mechanism in place whereby we can hedge some of the dollar exposure in a Sharia compliant way. And this allows us to just generate returns from the underlying assets, whether it's the equities or the sukuks, but not participate in the rand dollar volatility by using this Sharia compliant hedging mechanism.
Okay, that's a great answer. So Hassan, I hope that answers your questions. If it doesn't, pop me a mail and we can set up a meeting with you. Okay, guys, let me share my screen. I've got you for 10 minutes and then we're done for the morning. I'm going to share with you slightly just a bit on our Sharia opportunity set. So many of you may not have sat through our FPI annual refresher in the beginning of the year. You could potentially be an IFA that's logged in this morning, listening just for some macro and Sharia information or information on stock picks that we like and that we don't like, and stock detractors. And this could be the very first time that you may have an exposure to Sharia market and maybe don't understand the potential that lies within it. So we just want to quickly highlight what we perceive the opportunity set to be. So in the investment space, we all know that asset managers all compete for the same slice of the pie, or the same pie gets cut up in different ways. We see that even with the DFMs, where we talk about flows in the market. A lot of flows went into DFMs, but where did the flows come from? It came from conventional managers. And obviously, that's not conducive to sustainable growth in the investment market. So as an asset manager in the beginning of the year, I started with Sentio in May of last year. We had to have a look and say, well, where can we compete and where can we offer an advisor an opportunity to have a little bit of blue sky or blue sea where they can actually get into a market that's actually untapped. And this is sort of what we came up. This is the tagline. Are you ready to explore a market with 90% untapped opportunity? So we valued the market, and then we saw what the market penetration was currently, and then we actually saw 90% of this market is potentially untapped. And that in anyone's mind is actually a great proposition. So this is the Sharia investment market. So current investment in Sharia products, now excluding bank accounts, is roughly calculated to be roughly 25 billion rand. Now that relative to the market, the conventional investment market, is not a lot of money. And we understand that. And maybe this is the reason why, as an advisor, you could tend to gloss over it and say, well, geez, there can't be any potential here because look at the size of the market. But don't let this fool you, because according to some serious market sources, which we can give you the references, but we won't name them in this presentation, the estimated size of the market, including bank accounts and institutional investment, where we fall in unit trust, is estimated to be 200 billion. Now, that's an immediate calculation. So that's what the market could be worth today. So you can very well see that 90% of the market is actually untapped. The percentage of wealth owned by the Muslim community in South Africa, estimated to be roughly about 20%. So even though the Muslim community makes up roughly 3 to 4% of South Africa's population, 20% of the total wealth in South Africa is owned by the Muslim community, and there's a very specific reason for this. Muslim communities tend to work very well together in terms of managing intergenerational wealth. They look after each other in family structures. Younger Muslim clients tend to be professionals, so they tend to be doctors or whatever the case may be, attorneys, accountants. So the profile of the client is professional, and it tends to be professional, and that's why this scenario exists. So yes, the market is small. Yes, the market potential is rather sizable. And now we've given you reason why we believe that to be the case. These estimates are fair guesses, and it's not on the extravagant end. It is actually rather conservative. So the question may be, why the potential in the market? So quite simply, more sophisticated offerings are being developed to address the Sharia compliant investor. Now, people on this session have logged in from all over the country. But if you drive into Johannesburg, and it's something that I've noticed, there is a big billboard next to the M2 from Bright. It's a short-term insurer where they're actually making available Sharia compliant short-term insurance. Now, the reason there's this potential is because product sets are being developed that actually look after the needs of Sharia clients or Muslim clients. And Muslim clients used to be forced into accepting conventional solutions, and they are very open to actually going into solutions that actually align a bit with their faith. So just because they never invested into the conventional space doesn't mean they don't want to. But this is one of the reasons. So the sophisticated offerings are being developed. So from a Sentio perspective, we've got a Sharia equity, Sharia balanced, and we brought a Sharia income fund into the portfolio. So we sort of rounded out the portfolio. At some point, we will probably offer a Sharia global fund as well. And now we've actually conventionalized the solution set that we've been able to offer to our Sharia clients. Ongoing education of the IFA and the end consumer. So Sentio spends a lot of time in consumer education. We engage in sessions where we talk about Sharia investing, what it is and what it's not. There's a lot of preconceived notions about what it entails, how the process works. And it's a lot of times it's actually not grounded in a good understanding of the process. So faith-based beliefs apart, there's actually a very robust process which gets implemented in order to build Sharia compliant portfolios. Processes that actually make these portfolios very good diversifiers during times of high volatility or high interest rate cycles. So ongoing education for the IFA to understand what potential needs, even if you don't work in the Sharia market, you could potentially have clients that could benefit from this. You could work in the Sharia market, and yet you still would need some good ongoing education. And that's why we believe if we keep educating the IFA and the end client, we will be able to tap some of this potential in the market. And then access to global investing opportunities. And this is where we've found a little bit of pushback, and I think Hassan's question pointed to that, is if you only invest locally, the solution set for Sharia is actually rather small. That's why you have to look globally, and at Sentio we do look globally. And once you implement a very global process or a robust global process into the overall managing of the portfolio, you actually hedge against the potential exposure that you have in terms of concentration risk by only investing in local Sharia compliant portfolios or companies. I think it's roughly between 55 and 65 companies locally. So it's about a third, roughly of the JSE that's available to Sharia investors. So you have to go global in terms of this. So some of the major milestones that we've had, and this just goes to show, even if it hasn't happened locally yet, guys, globally, this market has grown. So in 1975, the first modern Islamic bank in Dubai, and we've all seen the growth that's happened there. In the 90s, Sharia compliant mutual funds, that's more in the United States. A mutual fund is a unit trust, just called a different name. 2006, Dow Jones Islamic Market Index was launched. That obviously is great because it gives a Sharia investor opportunity to go global. 2015, Islamic finance assets surpassed $2 trillion. And now if we measure the potential 200 billion rand, according to the market, we can see that we've actually got a very tiny slice of it. And then 2024, we've already covered it. Industry sources estimate the potential Sharia market in South Africa to be roughly 200 billion rand. If we're accurate, that remains to be seen. So Sharia, quite simply, a set of principles governing all aspects of the day-to-day activities of Muslims. It also then speaks to investing. So this actually talks about the time when you're investing and you're doing well in a business. When you are profitable, you put some of those profits aside for when things aren't going all that well. So it comes down to managing your profits in a very responsible way. But Sharia, that's how you pronounce it. Just for you that I know, it's a set of principles. It's not only for the investing world, it's just the day-to-day lives of our Muslim clients, and it governs their day-to-day activities. If you have any specific questions about that, Imtiaz is the right guy to ask. Then Sentio, as an investor, in 2023, we won a GIFA award as the best Islamic socially responsible investor, which is a nice accolade. It's not the first time around we've got a GIFA award. So it may be a award that you're not aware of or familiar with, but nonetheless, we submitted our process to internet and compared to international peers. And I think from an ethical perspective, this bodes very well because ethics is a very important part of the Sharia investment process. Then just quickly, guys, to wrap up our platform availability, we are working on becoming available on all of the platforms. If there's a specific platform that you support that we're not on, please send me an email and then we'll see how we can help you around that. Obviously, as we're building support, yes, we will get onto all of the platforms, but we are currently, all of our portfolios available on Glacier and Momentum, and there's selected portfolios available on all the other platforms. But if you've got a need, reach out to us, and as we work together in expanding our retail capability, we'll get onto all of the platforms. What do you need to do to simply stay in touch with us? Quite simply, you can visit our website, download our brochure. We've got a Sharia brochure. If you want it, I can send it to you. Pop me an email. Please go on to LinkedIn and follow us. We do a lot of good social marketing and interesting things that we post about. Then join us again next month. This is a session that we're consistently refining to make it valuable, give you something to talk to clients about, just to keep in touch with Sentio. So join us monthly for our pulse sessions, and every quarter we've got face-to-face Coffee Connect sessions, normally in the office. But as we grow our retail footprint, we will bring Imtiaz along, and we have a session in Durban, Cape Town, and all the outlying regions. So that's pretty much it from me. So guys, that's it for the morning. I see we had a really good turnout. I'm very happy with this. Thank you so much for logging in. If there aren't any questions from anyone? Okay. If you have any questions, guys, get in touch. Thank you so much. We really appreciate you taking the time to join us, and stay healthy. I know flu is attacking a lot of us. Stay healthy, and we will see you again in 1 month's time. Thank you to Imtiaz for taking the time and sharing his insights with us. And to all of you, have a good rest of today.